Every month, you make a payment, principal and interest, and you're told this is how lending works. The bank gave you money, so naturally, you pay them back with a fee for the service. But here's the thing that keeps economists up at night. The bank didn't actually give you money that already existed, because when you signed that loan agreement, the bank didn't go to a vault, didn't withdraw funds from depositors' accounts, didn't transfer anything at all. They simply typed numbers into a computer and created new money that didn't exist 30 seconds before you signed. So if they created it out of thin air, why are you paying interest on it? This isn't a fringe theory. This is how the Bank of England, the Federal Reserve, and the Bundesbank describe the process, and once you understand what's really happening, the entire financial system starts to look very different. To understand how we got here, we need to go back to when banks actually did lend out existing money. In the 17th and 18th centuries, banks operated on what we'd recognize as common sense. A goldsmith would hold your gold, give you a receipt, and if someone wanted to borrow, the goldsmith would lend out that physical gold, and the interest made sense because they were temporarily giving up access to something scarce, something real, where risk and opportunity cost justified the fee. This model became known as fractional reserve banking, where banks kept a fraction of deposits in reserve and lent out the rest. It was simple, tangible, and it's what most people still think banks do today, but something changed, quietly, gradually, and by the time economists and central banks acknowledged it, the system had been transformed into something completely different, which raises the question, not just when this changed, but why nobody told us, and more importantly, why the old rules about interest still apply to a system that works nothing like it did 3 centuries ago. The transformation began in the early 20th century as paper money replaced gold and electronic records replaced paper ledgers, and banks discovered something remarkable. As long as they maintained confidence, they didn't need to have the money before making a loan because the loan itself would create a deposit in the borrower's account, a deposit that would become part of the money supply. It was circular, but it worked. By the 1960s and 70s, this process had become standard practice, but the economics textbooks hadn't caught up because students were still being taught the loanable funds model, the idea that banks intermediate between savers and borrowers, moving money from one group to another, when the reality was that banks had become money creators where each loan brought new purchasing power into existence. So when you borrowed $100,000 for a house, that money didn't come from someone else's savings but was created at the moment the bank approved your loan and credited your account. But here's where it gets interesting. If banks can create money, why do they need depositors at all, and why do they pay such intense attention to their reserves and capital ratios? The answer would only become clear when the system nearly collapsed. Through the 1980s, 90s, and 2000s, this money creation process accelerated as financial deregulation removed many constraints, and banks discovered they could create vast amounts of new money through lending, especially for real estate. Between 1997 and 2007, UK banks increased the money supply by nearly 200% through lending, while in the United States similar expansion occurred, with most of this new money going into property markets, not productive business investment. And here's the critical part. Every pound, every dollar, every euro created through lending came with an interest obligation attached, where the banks created the principal but didn't create the money to pay the interest, meaning that money would have to come from somewhere else, from someone else's loan, from economic growth, or from default. The system worked as long as it kept expanding because new loans created new money to service old debts, asset prices rose creating collateral for more loans. It was a spiral where everyone benefited. Banks collected interest on money they'd created, homeowners saw their property values soar, governments collected taxes on all the economic activity, but spirals have a direction, and this one was about to reverse. 2008, the spiral stopped. When Lehman Brothers collapsed, banks suddenly realized something terrifying. The money they'd created was based on collateral that was now worthless, as mortgage-backed securities, once considered as safe as government bonds, were toxic, so banks stopped lending, not because they ran out of money, remember, they create it, but because they lost confidence, and without confidence, the money creation mechanism seized up. Here's the paradox that baffled policymakers. The banks had created trillions in new money on the way up, but they couldn't simply destroy it on the way down without causing complete collapse because every loan is simultaneously an asset for the bank and a deposit money, in the broader economy, so destroy one and you destroy both. Governments stepped in with bailouts, but here's what made people furious. The banks that had created money out of nothing, that had charged interest on that created money, were now being rescued with taxpayer funds, money that taxpayers had actually worked for, and the Bank of England was forced to articulate publicly what had been true for decades. Rather than banks receiving deposits when households save and then lending them out, bank lending creates deposits. In normal times, the central bank does not fix the amount of money in circulation. Finally, the truth was official, but by then, trillions in interest had already been collected. The response to 2008 was supposed to prevent this from happening again through higher capital requirements, stress tests, and tighter regulations, while central banks even engaged in quantitative easing, creating money themselves to purchase assets and inject liquidity into the system. But the fundamental mechanism remained unchanged because banks still create money when they lend. Interest is still charged on that created money, and the incentives still push banks toward expansion and risk. Between 2008 and 2020, global debt grew by $87 trillion. That's $87 trillion in new money created through lending, all of it carrying interest obligations, so the spiral resumed, just with slightly different rules. Iceland tried something different after their banking collapse by actually prosecuting bankers and restructuring their financial system, and their economy recovered faster than most, but Iceland is small, isolated, and could afford to experiment, while larger economies remained locked into the old system simply because the alternative, admitting the system needs fundamental redesign, was too threatening. Today, the patterns are repeating with eerie precision. Global debt has now reached $307 trillion, 3 times global GDP, up from just $87 trillion in 1999, and almost all of this new debt represents created money with interest obligations attached. Real estate in major cities has become unaffordable not because of supply constraints alone, but because banks can create unlimited money for property loans, driving prices beyond what wages alone could ever justify. A middle-class home in Toronto, Sydney, or London now costs 10 to 15 times median income, up from 3 to 4 times in the 1990s, and here's the shocking data point. In most developed economies, over 70% of new money created through lending goes into real estate and financial assets, not productive business investment. So the system that's supposed to allocate capital efficiently is actually inflating asset bubbles while productivity growth stagnates. The interest burden? In the United States alone, households, businesses, and government will pay over $1.5 trillion in interest this year. Not principal, just interest, on money that banks created through the lending process itself. So what does this mean for you? First takeaway, the interest you pay isn't compensation for someone else's sacrifice or delayed consumption but payment for a bank's ability to create money through accounting entries, which doesn't make the debt less real for you, but it reframes the moral logic of the system entirely. Second takeaway, the affordability crisis in housing isn't primarily about construction costs or zoning laws but about unlimited money creation chasing fixed assets. So until we address how money is created and where it flows, prices will continue to disconnect from incomes. Third takeaway, every recession, every debt crisis, every bailout is partly a consequence of this system because money is created through lending with interest obligations attached, but the interest isn't created, which creates a mathematical pressure toward perpetual growth, periodic defaults, or monetary expansion to prevent collapse. So here's the uncomfortable question we're left with. If we, as a society, can create money through our banking system, why do private institutions have this power, and why do they profit from it? Some economists argue for sovereign money systems where governments create money directly, others advocate for the current system with better regulation, still others believe decentralized cryptocurrencies offer an alternative, but the debate itself is barely happening because most people don't know what the current system actually is. The next time you make a loan payment, remember, the bank didn't loan you money they had, they created it, and the interest you're paying is the price of money creation being a private, profit-making enterprise. If this changed how you see the financial system, share this video because the more people who understand how money is actually created, the more we can have an honest conversation about whether this is the system we want, and drop a comment. Do you think money creation should be a public utility or remain in private hands? Let's discuss.